Okay, hi guys, Joe here from decodingmarkets.com. Welcome to this update of the 0 to 1 million portfolio for December. Now, this is a project I started last February, and the goal of this project is to prove that anyone can become a millionaire by investing a small amount into the stock market each month. It's also to prove that there are viable alternatives to index funds. You don't just need to follow the herd into low-cost ETFs. Yes, you can invest in individual stocks. And yes, this is a strategy that I have back tested on historical data. So what happened in December? Well, the first thing that happened in December was that we got a small dip right at the beginning of the month, and that coincided with news that a US-China trade deal might be off the table. But this wasn't a major event, and I wasn't quick enough to catch the market bottom. So my first purchase of the month, and if you remember, I like to buy one or two high quality stocks each month. So my first position was a brand new position in Starbucks Corp. And so I managed to buy Starbucks on December the 9th. So obviously Starbucks is a huge multinational company with a strong history of growth behind it. But I still feel Starbucks has a bright future. The company has managed to grow revenues in 9 of the last 10 years without taking on too much debt. And at the time of purchase, the stock was trading below 20 times EBITDA. Now, one of the main reasons why I like Starbucks at this point is that it is a quality stock, but it did sell off around 20% during the tail end of 2019. For me, that was partly due to competition from other market players, particularly the likes of Luckin Coffee, LK, the Chinese coffee shop, which has been experiencing a lot of growth in China. Now, obviously, Luckin Coffee has been doing quite well, but its success has largely come from price discounting, a lot of price discounting and a lot of growth fueled by debt. And this was reported in the Financial Times as well. Now, this business model for me is quite risky and could backfire. So the narrative that Starbucks is losing the battle for China, for me, is probably a little overdone. Then that's why I think this sell-off is probably gone a bit too far. But overall, the main reason why I wanted to buy Starbucks is it's got plenty of things to like about it. It's got large economies of scale, strong brand, and lots of other feedback loops. It's got a high quant score. So just overall, it ticks all the boxes for a long-term hold. And I was happy to enter this stock at $86.31 per share, which was a 13% discount to the 52-week high. And since I made that purchase, the stock has gained just under 3% since entry. So the next position I took in December was Chewy Inc. So Chewy is an e-commerce business. It's a website that caters for pets, pet products, medicines, and other animal supplies. And I was first alerted to this stock via an interesting article in the Wall Street Journal, so decided to take a closer look. And one thing that really impressed me was the revenue growth. The company's managed to grow revenues from 900 million in 2016 to more than 4.5 billion over the last 12 months. So the company is further branching out with its own pet products and animal pharmacies, and that also seems like a smart move for diversifying revenues. Now, although EBITDA is still negative, the business trades at only 2.5 times revenue, which is lower than most of the other hotshot IPOs that surfaced in 2019. So the reasoning behind this trade really is that Chewy has been unfairly put in this same basket as other overpriced IPOs. And in fact, if you look at just the fundamentals and the growth that is available in this industry, there is a good shot at being able to double Chewy's market cap to 20 billion over the next few years. So it's a market cap of only around 10 billion at the time and about 11 billion at the moment. And I also like the fact that pet businesses tend to be resilient during economic recessions, and I do think that could come in handy as we move through this mature part of the market cycle. So overall, Chewy doesn't exactly tick all of my boxes for a long-term hold, but I do have a lot of safe, reliable companies in the portfolio, and I felt there was enough potential in this one to take a bit of a punt. So I was happy to buy a portion of shares, and I got them at a price of $26.50. and that's proved to be a pretty good entry point. The stock's gone up about 10.72% since purchase. Okay, so those were the two positions that I entered in December. So let's now take a look at the performance for December and for the whole of the year. So overall, it's been an excellent December and an excellent first year for the 0 to $1 million portfolio. Starting in February, we have invested an average of $1,250 a month, and we've gone from a starting balance of 0 to just under $16,000, and that represents a total return of 16.04%. So if we were to carry on at this rate, which is probably unlikely, we would be able to hit $1 million in approximately 16 years, which is obviously pretty good. The return is also 65% better than our benchmark. So if we'd invested the same amount into the SPY ETF each month, into the S&P 500, even though we've had a stellar year in the markets, we currently only have an equity of $15,080, a return of only 9.68%. So we've done a lot better than the benchmark this year, so that's really good. Something to be really pleased with. To put these numbers into perspective, if you'd invested only $600 a month with this strategy, you'd now be sitting on roughly $7,659. That would take you over 20 years, just over 20 years to reach $1 million. Now, if you'd invested $2,000 a month with this strategy, you'd now have roughly $25,529, and at that rate you'd hit $1 million in only 13 years. So we currently hold a total of 13 high quality stocks and ETFs, and we also have a little bit of cash on hand in case of a market pullback. So that's how the 0 to 1 million portfolio has performed in 2019. So what's in store for 2020? Well, as we move forward into 2020, I'm going to continue this project, and I'm going to continue to invest in 1 or 2 high quality stocks each month. Now, markets, particularly US stocks, are certainly not cheap. They're basically being priced at 10% earnings growth for the first quarter. So that does seem quite high and implies there could be some disappointment on the cards. However, we don't know what's going to happen. It's impossible to predict what the future will bring, and we need to only focus on the long-term process. So if we keep investing into a selection of high-quality businesses, our returns should smooth out and grow over time, particularly as we're buying in at average prices, and we've got this regular investment process going on. So this is an ultra long-term portfolio. I'm very happy with how it's going so far. We've done really well in 2019, and let's hope for another good year in 2020. And if you want to find out more details about this strategy, just click on the link in the description and you can find out exactly how this strategy works and how you can implement it for yourself. It's very simple, but I think it's very robust, and it's very interesting and satisfying to do as well. So thanks a lot, and see you in next month's update.